The clock's ticking down, and you're actively throwing your hard-earned money straight into an absolute institutional furnace. Every single second you waste before the upcoming 30th of June deadline is costing you thousands of dollars in unrecoverable wealth. If you're over 45 with more than $300,000 sitting passively inside major industry funds or retail funds, you're the prime target for a massive tax bill, this EOFY. Today, we're launching an urgent rescue mission to claim your $30,000 tax deduction and completely shield your capital from the taxman's aggressive grip. It's an estimated $12,000 in instant cash savings that you can legally lock away into your personal compound engine right now. But before we dissect the technical execution step by step, remember, this is educational information only, does not constitute personal financial, taxation, or legal advice. Always consult a registered tax agent or licensed professional before making major shifts with your retirement cash flows. Now, let's create a bulletproof shield for your hard-earned balance before the system chokes your access completely. Let's look closely at how the game's played at the elite level across Australia. Most executives think their employer handles everything perfectly, with the mandatory superannuation guarantee flows. That's an incredibly dangerous myth that's bleeding you dry. Your corporate payroll department only does the bare minimum required by law, meaning they leave your wealth totally exposed to the maximum individual marginal tax rates of up to 45%. For the 2025-26 financial year, the standard cap for concessional contributions has been formally indexed up to $30,000. This isn't just a simple stat on a government website. It's your primary defensive weapon against extreme taxation layers by implementing a highly optimized salary sacrifice strategy right now. You're legally instructing your corporate payroll team to redirect a massive slice of your gross salary directly into your super fund before individual pay-as-you-go withholding can ever lay a hand on it. Instead of watching that premium tier of your income get shredded by a brutal 45% tax rate, it enters your retirement fund taxed at a tiny flat rate of just 15%. Think about the massive structural arbitrage you're creating inside your asset base by executing this single move before 30 June arrives. You're instantly rescuing 30 cents on every single dollar and trapping that clean profit inside your personal ecosystem where it can compound for decades completely undisturbed. But you can't just set and forget this strategy because the institutional providers thrive on your silence. Whether your money is sitting in standard industry funds or tied up in retail structures, they love charging high administration overlays while you absorb the full blow of unoptimized brackets. If you don't actively take command of your concessional contributions cap space before this financial year closes, forever, you're handing the ATO a massive cash tip that you'll never see again. It's an absolute financial tragedy that happens to thousands of successful Australians because they simply refuse to look at their statements until it's far too late to make structural adjustments. You've spent your entire career accumulating this capital, and letting it erode in the final weeks of the cycle is a luxury you simply can't afford. Bond, stop right there. Let's enforce an absolute hard dramatic pause because this is the exact moment where passive investors lose their entire competitive edge in the market. What's your single biggest financial pain or tax frustration, right? Now, drop a comment below immediately and let me know exactly what's keeping you awake at night. This EOFY. Let's expose the hidden bottlenecks together. Now that you've dropped your insights, let's unpack the hidden trap that explicitly targets high earners across Australia. It's an aggressive institutional clawback known as the Division 293 tax threshold. If your combined personal income and concessional contributions blast past the $250,000 milestone, the ATO will automatically slap an additional 15% tax on your superannuation inflows. It's a calculated sting designed specifically to penalize high net worth individuals who fail to map out their total compensation structures before the 30th of June deadline hits. Most corporate executives receive their Division 293 assessment notices months after the financial year ends, causing absolute chaos in their liquid cash reserves because they didn't factor the liability into their overarching wealth strategy. Managing this requires a deep understanding of how your remuneration package is structured between base salary, gross bonuses, and compulsory super guarantees. If you don't track your position proactively, you'll slide straight over that threshold line and face an unexpected debt notice that strips away your hard-earned financial momentum. But even if you optimize your contribution caps perfectly, there's a far more lethal hazard waiting for you in the final weeks of June that can completely annihilate your entire tax deduction plan. It's a widespread institutional disaster that we call the BPA death trap, and it absolutely destroys thousands of retirement strategies every single year. How does it catch successful professionals off guard? It's deceptively simple. An investor waits until the 28th of June or the 29th of June to execute a massive lump sum transfer into their fund via their personal banking portal. They assume that because the cash leaves their retail bank account instantly, their tax deduction is safely secured for that financial year. That's a catastrophic assumption that will cost you thousands of dollars. ATO legislation dictates that a contribution is only legally valid when it's officially received and cleared by your industry funds or retail funds, not when you initiate the clearing request from your personal app. If the interbank network takes 2 or 3 business days to process that heavy seasonal transaction volume, your capital lands in your fund on 2 July. Boom, your entire strategy is legally disqualified for that fiscal year. You're available $30,000. Cap space for the new period is accidentally choked, and you're suddenly hit with a massive, avoidable individual tax bill on money you thought was completely protected. It's an absolute administrative tragedy caused by simple transaction lag during the busiest financial week of the year. To bypass the BPA death trap, you must initiate your transfers weeks in advance or coordinate directly with your fund managers to verify real-time processing cutoffs. Let's look at the absolute peak of economic value inside this 2026 tax framework. It's the maximum exploitation of the 5-year carry-forward rules. If your total super balance was below $500,000 on the 30th June of the previous year, you have a legal loophole to sweep up every dollar of unused cap space from the past 5 years and deploy it in one single high-powered injection before the upcoming cutoff. This allows high earners to shield an estimated massive chunk of their current income from the top 45% individual brackets. But remember, general information only does not constitute personal financial, taxation, or legal advice. So you must verify your exact carry-forward thresholds inside your secure MyGov portal before deploying liquid capital into long-term institutional locks. Don't let the system win through processing friction or lack of tactical foresight this year. Take absolute command of your financial accounts right now and audit your contribution totals before the 30th of June gates. Close forever. If this urgent strategic breakdown helped you expose the hidden leaks in your retirement structure, make sure you prepare for what's coming next. In our upcoming exclusive video, we're going to completely unmask the hidden fee schedules that traditional retail funds use to quietly siphon off your wealth month after month without your explicit consent. Hit that subscribe button to Aussie Super Secrets right now and stop giving the tax office another single unearned dollar of your money. Disclaimer: The information provided in this video is for general educational purposes only and does not constitute financial, taxation, legal, or home loan advice. It has been prepared without taking into account personal objectives, financial situation, or needs. Before acting on any information, it is recommended to consider its appropriateness and consult with a licensed professional, such as a financial planner or tax agent. Specific results or future performance are not guaranteed. 2026 Aussie Super Secrets. All rights reserved.